Hello, fellow Rebel Capitals. Hope you're well. I am here with my good buddy Cuppy, and we got a lot going on. First and foremost, Cuppy, tell us, why on earth are you leveraged long NVIDIA?
Well, let me give you the long thesis.
Please
8% of
do.
every
Please do.
dollar that goes into a 401k has to buy NVIDIA. My dad, 8% of his retirement is probably NVIDIA. He doesn't really know what NVIDIA is, but look, it's a cheat code. Look, every dollar you make that you save is going to go to NVIDIA. And by 2030, about 150% of global electricity demand will go towards AI chips. That will create cat memes, and we'll all post them on Instagram in hologram form. And yes, that's the entire economy, is everyone doing AI.
there you go. Bye. As Jim Cramer would say. All right. Now, jokes aside, buddy, you came out with a couple blog posts recently that I thought were fantastic. And one thing that I get frustrated, a lot of my buddies that really aren't investors, they're in different industries, they'll send me like podcasts with Jensen, quote unquote, refuting these arguments that it's a circular type of AI economy bubble, whatever you want to call it. And he never gives specific numbers. Like they'll say, okay, well, you're investing in this and this is investing in that. And they'll never break down the actual math. Like where is the revenue going to come from? How much revenue are you expecting? And what is your cost going to be? The argument is from Jensen is always just, oh my gosh, I invested in this company and I should have invested more. Like, what does that even mean? And the thing I loved about your blog posts is you actually got out a pencil and a pad and said, hey, let me just do some math here. So walk us through the genesis of the first article. And then I really want to hear the stories about how many people within the AI space reached out to you before you wrote the second article.
Sure. So if people haven't read my blog post, go to preycap.com and take a skim of the two blog posts. It's free. But everyone's been telling me how great AI is, and I'm not smart enough to disagree with them. Look, I use AI. I think it's great. It's made me more productive mostly. It makes some mistakes along the way. It's kind of like a first-year analyst. But, it goes faster than a first-year analyst, and it's free. And so I'm not against AI, but I just started thinking about it. Like, if this is a great investment, like, what do the numbers have to be? And we're going to spend about $400 billion this year, which is a big number, on building data centers. And if you assume these things are like 3-year, 4-year depreciation curves, because, I mean, the data centers themselves don't last very long. They just keep changing the technology. Even the building itself is almost worthless. Like, I learned of some data centers that are dark right now. Like, they operated them for 3 years, and the technology changed in terms of the cooling systems, and they turned it dark. It's obsolete. But if you think these things last 3 to 5 years, and you assume like a 25% gross margin, which is kind of a made-up number, who the hell knows? You need kind of like $1 billion. $1 trillion for these data centers to about 500 billion for these to break even, and about $1 trillion if you want to earn like a 10% return on your capital. And that's not like in the future of all AI. That's the data centers that will be built this year. Next year, they're going to build even more data centers. Next year, you need 750 billion of revenue. I mean, you're looking over $1 trillion of revenue. And that, is before you pay $1 of financing costs or anything else. Like, that's how much revenue you need to break even if you're building these things. Right. And like I said, if you want to earn like a 10% return on capital, which seems kind of high in some speculative, capital equipment that depreciates fast, like, I don't know, you need like 2 trillion of revenue. And if you want like a good return, 3 or 4 trillion of revenue, I mean, these are huge numbers. Just remember, the Department of Defense spends, $1 trillion a year, and that includes aircraft carriers and stuff. We can't just shift everything to AI. And I don't know where this money comes from. Like, the total AI industry is going to be like 15 or 20 billion of revenue this year. And remember, you need 500 billion to break even.
Yep.
So you need a 30x growth. I don't know how you get there. The math doesn't make sense. Like, these people are building these things that have zero chance of earning a profit. And I think these venture capital guys, they see this model. I mean, they did it with Uber and they subsidized it for like a decade. I mean, it was great, right? You got to go anywhere you wanted for like in a city for $4. You know, it was like they're used to subsidizing this thing, and the size of this is so much bigger that they're all going to go broke before they get to the point of profitability, because in the end, no one pays for AI.
Yeah. So the argument that I've heard, and I think it's a legitimate argument, is that right now they're only making 12 billion a year because they're just going B2C. But the real
Okay.
play here is to integrate AI into everyone's life to where they get used to using it. They get like they have to have it. It's like a smartphone or something like that. And then what they're going to do is they're going to start selling it B2B. And when they sell it B2B, it makes sense for all these companies. Let's use Microsoft as an example, because let's say they spend whatever, $50 billion a year hiring employees or on their employees, on their human staff. And they can just eliminate that and just use AI. And then that's $50 billion of revenue that can go to OpenAI. And I've heard Jensen, as an example, say, well, look, we have a $120 trillion global economy. And he says 50% of that is just, let's say, people working on computers, as far as wages that are non-manual labor. And since AI is going to replace all of that, then that's $50 trillion of revenue, roughly speaking, that can go to OpenAI, and that's what's going to pay for all the data centers. So what would you say to that pushback? Because I'm sure you've heard that before.
So I don't think it's 50 trillion. I think it's like 5 trillion. If you get rid of the people who use computers, which tend to be the guys making the most money, where does the revenue come from? Like, I don't know how it works, right? There's no revenue then, because all the consumers, and remember, 10% of all the population is half of consumption. Well, those guys you're saying don't have jobs. Well, then where does the consumption come from? Where's the revenue? It's circular. Even if these guys win, they don't win. And look, I totally get it. In 10 years, I'll have an AI doctor. I'll do AI tax prep. I'll have AIs filing my Form ADV with the SEC. But look, if I use AI today and I do the Form ADV wrong, I'm going to be in a whole lot of trouble. And as we all know with AI, it's good. It's not great. And I don't want to risk, my career on them checking the right boxes. I want to hire someone very professional with a lot of experience doing this, who has a lot of liability insurance, so that when they get it wrong, we all sue each other. I'm having too much fun running a hedge fund to be going for depositions with the SEC. And no, I mean, it's not there yet, and it will get there. I know it will. Mm-hmm. But if we're spending 500 billion, let's say, a year today, maybe 600-700 billion next year, and maybe it's $1 trillion a year. I mean, I've heard they're going to spend 5 trillion by the end of this decade, which is kind of incredible, right? Because that's 7 times what we spent on the interstate highway, inflation adjusted. And like, highways are pretty cool, like they're useful, and AI makes cat memes. Look, I think we'll get there, but who's going to shell out $5 trillion to get there? And what's the return on getting there? Like, I'm this old school boomer that kind of is a cash out, cash in sort of guy. And I get venture capital, you cash out and the cash doesn't come back in for a couple of years, and maybe it's a decade. But at some point, the cash has to come back in. And the longer it's deferred, the better your returns better be over that cycle. And like we talked about, there is no return. And if you put 5 trillion in, and maybe it grows from 15 billion this year to 50 billion, like, there's still no return. I mean, that's not like the profit, 50 billion. That's like the revenue.
Right.
Because look, LLMs, they're so damn good. The free version is going to be good enough forever, especially if the free version gets, 25, 50% better every year from here. No one's going to pay for this. No one's going to pay for any of this stuff.
Yeah,
even when you have like Dr. AI, there'll be 10 different AIs, and they're all going to be free.
Yeah, that's, I think, my biggest concern. And that would be my biggest pushback to the AI hyperscaler hyper bulls, is you're dealing with a commodity. Like, no one has any affinity towards OpenAI or ChatGPT versus Gemini. If Gemini comes out with a better version, then you're going to use Gemini. or if whatever Claude comes out with a better version, you just switch over and start using
Yeah.
Claude. There's no network effect. Like all your friends are on Facebook, so you have to be on Facebook, or all the hedge fund managers are on Twitter, so you have to be on Twitter. There's none of that with AI. Now, it is true that Microsoft has this Azure product. I don't know if I'm pronouncing it right. You probably know what I'm talking about. And so it's their back end where they can create all these upsells with cloud computing and whatnot. And so once a company starts using that, then they're integrated into the ecosystem and it's very hard for them to leave. I get it. And so what they do is they bring on AI as a tool to make sure that they're keeping that customer in place and that customer is not leaving. But unfortunately, there's a cost to bring in that tool, and that lowers the margin. And I think that the argument there, of course, is that Microsoft is going to be able to fire all of their employees, and then they're going. Let's say they're paying an employee $100,000. Well, now all of a sudden they can pay OpenAI $99,000 or $90,000, and it makes sense. But my point there is the commodity component of this doesn't prevent Claude or Anthropic from coming in and saying, okay, OpenAI is charging you 90, we'll charge you 50. And then OpenAI says, okay, we'll charge you 40. And then Claude says, okay, we'll charge you 30. And you just go, you get a race all the way down to the bottom to where you're maybe 1% higher than the energy costs. And that 1% is what's going to, let's just say OpenAI, or going to Anthropic. And so that's the problem with the providers, is that it's a commodity. Do you have any insights on that, or do you think I'm seeing this incorrectly?
This goes on until someone refuses to fund it. That's the answer. You have multiple players who this is almost existential. You have the hyperscalers that have genuine cash flow and profits, plus huge capacity to borrow money. You have private equity that once you're in for a penny, you're in for a pound, especially because you mark to model for 10 years. So you just get to earn fees and no one even knows what this stuff is valued at. And you have VC with tons of money. I think the best comparable is the Transcontinental Railroad. We built a few of these things, and it didn't really matter which route you took. There was a better route, there was a less good route, but the trains have to run, and there's a fixed cost of running those trains and maintaining the track. And so they ran these things at a loss because it was better to run it at a small loss than a big loss. And they all fought for the cargoes. There really weren't enough cargoes. And they all went broke many, many, many times. And look, those railroad tracks are still operating. Those routes, I mean, they've modified them 150 years later. We're still using these. Like, it's great that we built the Transcontinental Railroad, but everyone who invested in it through every stage of the capital cycle, debt, equity, everything, they all went broke many, many, many times. And I think that's what's going to happen with AI. They're just going to keep putting more and more capital into this and just go broke over and over again. And maybe, Microsoft or Meta, like, they don't go broke, but they go to the equivalent of broke, where, they just write off, $500 billion of investment and start again. I mean, these guys have been kind of crafty, right? Like, you talked about these circular transactions. I don't think anyone really plans to spend $100 trillion on one of these deals. I mean, they're there for the press release. It's really kind of cover for private equity to go take capital and build a data center. And you have these data centers. So it's a $10 billion data center. And maybe, Meta or Microsoft, they come in for 500 million, $1 billion of equity. So it looks like, oh, they're taking the risky piece. This is safe. And then they do a contract. We'll lease this data center for 15 years. Oh, that seems really safe, because, Microsoft can't possibly break a lease. Like, we've never seen a take or pay contract, abrogated sometime. I mean, that happens like every 5 years in pipelines. But then under that, you get to have some private equity bros that come in for like 9% subordinated debt. And you should know, like, if it's 9% debt, then there's something wrong with it, right?
Right.
And then you have like your PIMCOs of the world, which means my dad's retirement account is buying, the super safe senior debt. And that's coming in at 7%, which should tell you something's wrong with it, right? Because, I mean, safe debt is the US Treasury at 4%. Mm-hmm. And I think it's going to act a lot like CDOs, where, I mean, people took these CDOs and they took basically CDO squares. They took the worst part of a CDO and they put it into a new structure, and they called it a CDO squared, and all the top pieces of it were AAA. And what we learned is that if you kind of mix raisins with turds, you mostly just have turds. And these things, they just turned out all bad. I mean, they had 90% loss ratios. And what happens when you have a data center and the technology changes? And year 5, it turns out that the cooling system needs to go below instead of above. And whoops, you didn't build a basement. Well, and this is what we've seen happen with these data centers over and over again, because the technology is moving. And look, I'm sure the guys running Meta and Microsoft, they're really nice guys. But with a 12-year lease, do you think they're going to keep paying? Or are they going to find some excuse in some rogue court somewhere and say, we're going to break the contract? And then you'll litigate for 5 years against each other, and you'll probably get 2/3 of your money back, half your money back, and after legal fees, you'll get way less. But that's how this always works. I mean, we've seen this with take or pay contracts in pipelines. Like, no one wants to fill a pipeline for 20 years if the oil field goes bad. You find a way to get out of it. That's the same that happened here. So you're basically financializing these things, and the Microsofts of the world. I mean, look. They didn't get to be really rich by being stupid. They're finding suckers to take up the slack. And some of these are companies like CoreWeave, which is just like a giant stock promote. I mean, look, I saw a press release today. The stock was up on the day because insiders only sold $2 billion today. Normally they're selling usually they're selling like 3 or 4 billion a day. Today was a slow day. I don't know. Maybe they went yacht shopping or something in the afternoon and forgot to put a new sell order in. But I mean,
how about the rate of change?
2 billion is the new bullish. Look, the insiders can't sell fast enough. That should tell you what they think of this asset. And yes, you can announce as many $100 billion transactions as you want amongst 10 companies, all doing the same thing with each other. There's no. I don't know if I want to say there's no, but I'm really skeptical, right? Like, I was a little kid back in 2000, but I saw how this worked. You had companies like Lucent and Nortel, which they were the NVIDIAs of the day, and they would do vendor financing with their customers, which were telecoms that couldn't raise any more money. The capital markets kind of shut them off. And so they'd announce these huge deals where we're going to, lend billions of dollars to this company, trying to get, Wall Street to be like, oh, this must be safe if, Nortel is willing to lend them money. And then Nortel would say, look, we're going to lease spectrum and fiber optic capacity on your telecom system. And what did that do? It just created revenue. I mean, why does Nortel need capacity, on a telecom system? And so what they did was they created this fake revenue that then went right back to Nortel to pay the interest expense on the debt that Nortel had lent. Right. But when you then take equity in return and then you mark up the equity value, you get to book profits at Nortel. Like, they did all these tricks. And so the incentive is then to do, well, let's add a zero to all these numbers. Okay. I'm going to rent this capacity for way above market. I have no idea what the market price is. Like, there's one person alive that knows what the market price should be. We're going to rent it for way above market. You're going to use this money to buy more stuff from us. We're going to send you $1 billion. You're going to send us $1 billion. We're going to do it over and over and over again. It got to be called round tripping because all the numbers were fake. The same $1 billion just kept going in a circle. And it was meant to trick Wall Street into putting more capital in. And eventually Wall Street got wise to it, but not before, retired people lost, tens of billions of dollars, much like will happen this cycle, except this time it'll be like trillions. And look, they all went bankrupt. A bunch of guys went to jail. It was all fraud. I mean, some of these guys like Adelphia might still be in jail.
Yeah. And it might not repeat, but it definitely rhymes.
It always rhymes.
It just seems like, okay, we went from funding all of this CapEx out of free cash flow. And now it kind of seems like they're funding it out of debt and equity. And at a certain point that runway ends. And it's like, can you get these profits that are expected, these trillions and trillions and trillions of dollars of profits from, where we are right now at 12 billion in revenue? Can you get it in time enough to where you go from free cash flow funding to debt funding back to free cash flow?
Of course,
I think that's the question here. And I think the probability of that is extremely low. It seems like some of the big players like Microsoft and Google are basically just dumping billions into this, or Meta, because they don't have a choice. It's not like they think it's profitable. It's like, I have to do this or I'm going to lose market share. Do you get a sense of that happening behind the scenes?
I think it's really existential. I think you're right, actually. I think a lot of these guys look at it and say, we don't want to fall behind on this new technology. We don't really understand what it is.
Yeah, yeah.
But if we fall behind, what do we have? And I mean, you can look at the big players spending the most, okay? Google, I haven't used Google search in 6 months now.
Right, right.
What do they have? They have their own AI search. Well, there's no advertising. Google search, they bastardize it so much. You ask it a question like, what's the weather going to be tomorrow? And it just sends you like 100 things to click with banners. And it's just, became annoying. And they have nothing. Search is their business. Waymo's cool, but it's not making money. And so they have no choice. They don't have a business in 10 years or maybe 10 months. Meta, like, who uses Facebook anymore? Instagram lost out to TikTok. What does Zuck have in 5 years? It's existential. He has cash flow today. He might as well roll the dice.
Yeah, it's like they don't have a choice to roll the dice. Like they're being pushed out the risk curve, like the retail investor over the last 15 years.
Well, look at who's not spending money. You know, Amazon's not spending money. This doesn't matter to them. You know, Apple's not spending money. This doesn't really matter to them.
Yeah.
I think
what's interesting about that, dude, is I was doing some research the other day for pets.com because some of the feedback I was getting is, oh, this is nothing like the .com bust because, you know, look at pets.com. It didn't even have revenue and no one in their right mind would have invested in that company. It was totally and completely irrational. So what I did is I actually used ChatGPT and said, hey, give me the bullish argument with sources for pets.com. And if you read the bullish argument back then from 1998, it was actually very rational. It was very rational. It was extremely valid. It made a lot of sense. Like I was like, hey, yeah, this sounds good. Where do I buy? And but the funny part was, you know who the largest investor in pets.com was at the very beginning?
Who?
Bezos. It was Bezos and Amazon. So the point, so I think it's funny that you say that Bezos is kind of sitting on the sidelines on this one
burned.
because he was the largest investor in pets.com. So there you go. Maybe that's
incredible. I mean, look, you said something before and you said that these things often rhyme. And I think that's so important to being an investor.
Yeah.
Like, I remember how bad the 2000 bubble was. We had family friends that were, you know, not like super rich, but like they were in their 50s. They could have retired. And instead of just cruise control with a portfolio, they put it all into tech stocks. And some of them are still working now in their 70s. Like they went broke. Yeah. With margin debt and everything. Like, it's incredible how these cycles go. And I never thought we'd see another one of these cycles in my lifetime. I thought they'd space it, 100 years. Instead, 25 years later, we're doing it again because they printed too much money and guys made too much money doing stupid things. Especially in the VC world. Like, they made so much money just by force of will and by throwing capital at stuff that they assumed that if you just throw enough capital at it, eventually you'll have a business plan. Right. And I don't know. I still have no idea how they're going to monetize this. It's really quite incredible.
Yeah, that's really the bottom line here. So now I want to discuss something a little bit off topic because I know that just before we went live, the market was tanking. I don't know if it's still tanking. Is it really?
I keep looking away like a frantic.
Yeah, but this is very topical as well because we've got the AI bubble and people need to read your research on that, read the math, and then also listen to the stories of the insiders that were actually calling you on the phone.
I think that's interesting, actually. Let's stop there and talk about this for a second.
Okay, cool.
So I wrote this blog post and I have a decent following, nothing like yours, but I have a decent following. And people came out of the woodwork to say, Cuppy, I agree with you. I'm so happy you're saying this. I thought it was crazy. I just go home from work every day and I say, how is my company going to make money? And
but these are inside. I want to be clear. Yeah. These are insiders. These aren't just random people on FinTwit like me saying, "Oh, dude, I'm so glad you're saying this because this is what I was thinking." These are actually people who are working in the AI space right now.
and they were kind of like pre-selected by friends. Like I wasn't going to talk to some junior guy because I wanted to talk to guys that knew what they're talking about. I
Yeah.
talked to one guy that owns a bunch of data centers. Actually, he's the CEO of a data center company, which is fascinating. I talked to two guys in private equity, one on the credit side, one on the equity side of these things. I mean, these guys literally told me, like, we own billions of dollars of this stuff and we think it's worthless. I talked to a guy doing cooling tech. I talked to guys in chip design. I talked to a couple of VC guys where, I mean, there's one VC guy is like, yeah, we just did another funding. It's up a couple billion from our last funding valuation. We have like 100 grand of revenue. Like I keep telling my board,
100,000.
Yeah, he's like, I keep telling my board, let's just SPAC this thing and be done. This thing, like, it's not worth it. And then the board's just like, no, the valuation goes up like every 6 months, it doubles. Like, why would we sell out now? And he's like, you don't get it. Like, I don't understand what I'm doing. And all these senior people are like, I'm surrounded by guys that literally believe this is the future. And they're there doing the dollar and cents thing. And they're like, the numbers don't work. We have negative scaling. The more money we invest in this, the more money we lose. Like we normally these sort of businesses eventually have some scale benefits. And I talked to about 24 guys, and I don't want to, dox anyone. So I want to be careful what I say, but they pretty much universally thought that this was insane, and they had no idea how this makes sense. And I think the real takeaway from my blog post was that, and this is kind of this funny expression, like everyone knows, but nobody knows that everyone knows.
Yeah. Yeah. It's like the emperor wearing no clothes.
Exactly. Like, and these guys, like I asked them, like, why? He's like, why don't you have this conversation? He's like, I can't tell my board, they're going to fire me. They both think I have no vision. I can't tell employees, they're all going to quit and go to a company that, is excited about this. I can't talk to anyone. Like these guys, it was almost like a crying session. They just called me up and because they have no one to talk to. Like they literally are scared that if they say something, it'll get back to the people financing these things. And then they will be out of jobs.
Right.
It's just super weird. But it also made me think that my numbers weren't wrong. There was one guy at a hedge fund that had large AI investments that said what you said, basically, about how a lot of these really high salary jobs, doctors, lawyers, accountants, like this is all gonna be taken away. And I think he's right.
So do I, by the way. So do I. I just think it's going to be offset by the energy cost, by the increase in usage of AI that the Microsofts of the world have to absorb.
Yeah. And I just think he's also, 10 years early. And when you discount that back to in current cash flow, it's worth nothing. But look, I understand where he's coming from. That's the bull thesis. No one was able to tell me, Cuppy, you don't get it. Here's 100 billion next year going on 500 billion the year after. I mean, I asked these guys, they're like, yeah, the revenue might double. But even that revenue, maybe it goes from, 15, 20 billion to 30, 40 billion next year. A lot of that is actually round trip revenue too.
Right.
It's Microsoft buying stuff from CoreWeave and CoreWeave buying stuff from this guy. And how much of it is actual net revenue? These are private companies. They don't report much to you. If the number was really good, they'd be having press releases about it.
Yeah. One thing I noticed too is you always got to pay closer attention to people's actions than their actual words. And Altman is coming out saying, of course, he's pumping everything, saying how great it is. But then you look at his actions and he's making all of these investments in other companies. And companies I noticed that likely won't go bust, like AMD. So I'm thinking to myself, okay, well, if he's so bullish on his company, why isn't he taking that capital and reinvesting it in OpenAI? Like, why is he taking that capital and investing it in all these other companies that likely wouldn't go bust or might not be a commoditized or might not have a commoditized product? So that's one thing that was kind of a red flag. Another thing I'll tell you, anecdotal story, is out at the golf course last weekend. And I'm a member at a club here in Medellin. So you always get the gringo tourists coming down here and playing golf on their holiday weekend. And so there was this guy that I was talking to, and you could tell that he was you very, let's just say, a retail type of investor, just kind of FOMO and kind of the guy that buys like cryptos or something. But he had a lot of money. And he said that what he was doing right now is he was going up, and he and this his partner or whatever, they created this LLC where they're buying up land next to like nat gas facilities, and they're kind of doing the infrastructure for the data center in hopes to go ahead and flip it to like a Google or a Microsoft or whoever, OpenAI. And I just thought, it reminded me of like 2006, 2007, when everyone was getting in single family homes and flipping them to try to get a profit because they know that housing prices always go up. And it just reminded me of the exact same thing. But instead of flipping houses, now all of a sudden we're flipping land for data centers. Hey guys, everyone knows we are in a huge AI bubble right now, but the question becomes, what do you do about it? How do you protect your wealth and hopefully grow your wealth in these crazy volatile times we're living in? Well, I've got good news for you. October 29th, I'm going to be doing a free webinar training where I'm going to show you step by step the contrarian strategies the pros use to invest during financial bubbles and how they take potential crisis and turn it into opportunity. I'm also going to reveal why the typical approach investors take, which is just buy and hold, buy the dip, or just buy a passive S&P index fund, is the opposite of what you actually want to do, and how that might have worked in the past, but it likely will not work moving forward. Oh, but wait, there is more. The best part about this webinar training is that I'm going to be giving every single person who attends a free bonus. That's right. This bonus is a $500 coupon code for Rebel Capitalist Live. This is the conference, the investment conference I do every single year. It's in Orlando, 2026, end of May. It's going to be absolutely epic. This is an event you don't want to miss. And just by attending that webinar, you're going to get a coupon code that takes the price of a ticket from $599 all the way down to $99. So if you'd like the cheat code the pros use to invest in financial bubbles, and you'd like this incredible free bonus for Rebel Capitalist Live, you can go ahead and click the link in the description below, and I will see you October 29th.
It's all crazy. I was at a wedding about 6 weeks ago, and I saw some aunts and uncles I haven't seen in 5 years. And I'm always like the finance guy, and they always want to give me their stock
Yeah,
picks.
yeah.
And I'd say the 60-40 portfolio now is 60% NVIDIA and 40% Bitcoin, except for guys have like the 3x levered version. And these guys, man, like some of my cousins were like up 150% this year. And I feel bad because I do this for professional living and I'm having an okay year, but nothing like 150.
Yeah.
And they're like, Cuppy, you could buy call options of these 3x levered thing, and then you make like 6x your money. And I'm thinking to myself, I've seen this before. Like I know how the story ends. It's going to last longer. They're going to make more money. Like, look, a lot of the economy that you see today is people with stock market gains going out there and spending.
Yeah, I totally agree.
The vast majority of people are getting crushed by inflation. But if you have, 6x levered NVIDIA, yeah, you can go out there and spend tons of money, go on vacation whenever you want. That's basically like a last gasp driving the economy. Because as soon as NVIDIA has like 2 down weeks, all these guys get a margin call. Like, I've seen how this works. And it's why you have market crashes too. I mean, we've never had a down 10% with everyone long 3x stuff. I mean, this stuff has margin calls. Like, it's scary, right?
Yeah, and another ironic thing too is I think a lot of the reason why NVIDIA is a $4 trillion company or whatever is because of passive flows.
Oh yeah,
right? It's going into the S&P, and it's obviously a weighted index, so they're getting 8 cents for every dollar that goes in. But what happens is if AI is so brilliant, and if AI takes all the jobs, then the passive flows go to passive outflows. And now all of a sudden, every dollar that comes out is 8 cents is taken from NVIDIA. So it's like damned if you do, damned if you don't.
I think a lot of that happens. And then Look, I have a really bearish outlook for the world. I don't know, No, look, I think this AI actually takes a lot of jobs away. I think it starts slow and it just keeps going.
Yeah. So
It's not going to be, an immediate thing. It's more going to be people saying, maybe we don't have to hire, maybe, let's just see how this AI goes for a year. We're going to grow our business. Let's make everyone work, double overtime. Let's just wait, because why hire people if you're just going to train them and fire them? I think you just have this really inflationary kind of clusterfuckety economy. I mean,
how do you have inflation in that type of environment? You've got disinflationary pressures, especially if it's eating away at the job market. The unemployment rate goes up, the passive inflows go to passive outflows, the market goes down, you get a bull market, and that's all the spending in the K-shaped economy.
in a democracy, you always get inflation.
Yeah.
Look,
You do, but it's the rate of change, right?
Yeah, but I think especially guys like Trump that look, for a guy who pretends to be free market, he sure loves his central planning. I think they're going to do stimmies and weird fiscal, and you're just going to see all sorts of weird adjustments all over the place. It's going to be a really difficult world to trade and invest in.
Yeah, yeah.
But I also think you could have a world where, like the Great Depression, the average guy lost 15 to 25% of their living standards in the 1930s. Why don't we have a repeat of that, except for it happens with inflation? It's not this deflationary bust that everyone's terrified of. It just kind of looks more like Argentina. And I think that's the worst possible scenario, because there's not a lot of good investments in that world.
Or I think what it looks like is the United States 2021 and 2022. Or the 1940s. That's what I always compare it to, because I see as if the government just stood back and did nothing, I think the fundamentals of the economy would lead to disinflation, or maybe even outright deflation.
Oh yeah.
But with the government stepping in with stimmies, I mean, it's a great example, like I said, is 2020 and 2021, where left to its own devices, we would have had like 15% deflation. I mean, the whole thing would have completely collapsed in a deflationary bust.
You would have lost the entire banking sector, like through COVID.
Yeah, but the government stepped in, to your point, with the stimmies, and they distorted the economy. You get all these supply shocks, and the net result was actually 9% CPI. And that was, I think, very similar to what happened in the 1940s. They had price controls and all these things. So I agree. I think the economy wants to deflate, but the government is going to step in and just do this insanity that's going to lead to these temporary spikes in inflation, very similar to what we got in the 1940s. I always remind people, in 47, the CPI was at 19%. And 2 years later, it was -2. And it just this massive roller coaster ride. It kind of seems like we're in store for something extremely similar. But you were talking about Trump, and look, you can like Trump, you can hate him, whatever. He's definitely, let's say, unconventional. So you had another post. I don't know if this is a blog post or just something you did on Twitter, where you're talking about your daily routine as a hedge fund manager, trying to, or in the Trump world, and how it's quite a bit different than it was even with Biden or Trump 1.0. Can you kind of give us the Reader's Digest version on that?
Yeah, sure. I mean, look, I kind of miss the days of Biden. He'd kind of wake up at noon. They'd put him in a suit. He'd shake hands with a cloud and then kind of wander off the stage. Like nothing ever happened, right?
Yeah.
Trump, he's up 24/7. He's incredible, right? He has this energy, and he's just like throwing bombs at everyone. But he's not like a normal politician where they kind of like leak something in the Washington Post and they see what the approval ratings are, and then they leak it somewhere else. He has some like time. Trump is just kind of like press his tweet and he goes, "I'm going golfing." And
Yeah.
the world's like, "What does this tweet mean?" Like, look, I'm talking to you right now and the market's down 2% because of a tweet.
Is that what happened? Yeah, I know you keep looking over. And by the way, guys, Cuppy's looking over at his screen, because just before we went live, like we said earlier, something happened where the market just tanked. I didn't know. And Cuppy said it was a result of something that Trump said. So go figure.
Yeah, look, this could all change in 10 minutes, but we're having an okay day. We're short the world. We're long volatility. We're long Japanese yen. long gold.
But the market was up about 50 basis points, what, the S&P, and then now we're
not anymore.
And this is a result of, what did Trump say?
Oh, he said he doesn't want to meet with Xi. He's really mad at Xi.
And that was it. All right. So
he may have tweeted again. We've been talking for 20 minutes, but look, when you're in the world of Trump, you have to think a little different. You can't run max leverage. You can't run fully exposed. You always need to have a bit of extra cash. You always need to have some crash puts. And you kind of want to fade it. Trump always does the same thing, shock and awe, and then he kind of walks it back a little.
Yeah, right.
So you're better off with more of a market-making mindset as opposed to a trend-following mindset, if that makes sense. And, I've had to adjust how I approach the market. We all should. But it also creates this manic frustration where you never know what he's going to do next. And I remember I used to be able to go have a meeting. I used to be able to go to lunch with some friends and talk about the markets. Now I can't. I have to be here in case he tweets. You don't know what time he's going to tweet at. I check my phone every 3 minutes. I wake up at like every 30 minutes at night. Has he said anything? Who are we tariffing today? Like, then you stop and you're like, good, I dodged a bomb. We don't have any exposure to this guy.
Right.
It's just been so difficult and frustrating for a guy like me that I'm very risk adverse. I try to be really disciplined. It's just harder because you don't really know who's immune and who's safe anymore. And a lot of the things he does, they don't really have a lot of logic to them. I think in a mosaic format, like I get what he's trying to accomplish, but oftentimes there's weird collateral damage where something happens and then, it's not really meant at one of my companies, but it just, I like to joke, I lived in Mongolia and I ran a business in Mongolia for over a decade. I like to joke that, my biggest fear was always that the government would pass a law confiscating all the assets owned by a guy named K. Anyone whose last name started with a K would have all their assets confiscated.
Yeah,
and then
random.
As the dream goes on, one of my Mongolian friends comes to me from Parliament and he says, "Oh, Cuppy, we're sorry. We're going after Mr. Kim, the Korean guy. You're just a K, Cuppy? Oh, if you don't say anything to the State Department and you just kind of play nice, we'll give you your assets back in 6 months." And that's kind of how Mongolia would work. And that's kind of how Trump works. It's a very Vietnamese sort of Mongolian, dictator mentality, which makes it hard to invest. Which means that, look, I think equity multiples should be lower just based on that weird volatility of economic outcomes. Instead, we have historic highs in valuation. We should trade more in line with a banana republic because we increasingly feel like one. But
so
no one cares what I think.
So, but what do you do as a fund manager? I mean, you don't have to get into all your strategies and whatnot, but what are just some simple things that you do differently now than what you did during Biden?
Well, to start with, I have a negative economic view of the world. I want to be in things that are anti-fragile. I want to be in things that don't rely on government revenue, government support, the government doing the right thing on a permit or something like that. I want to be, out of the government's, target zone. I want to be in things that have no GDP exposure. I mean, that's been really important to me. I want to be in things where if the economy does horrible, which is what I expect, my businesses aren't impacted. Obviously, economic growth is usually better for my sort of businesses, but I don't want to be suffering. It's a very different, portfolio makeup. And then finally, I just run with less exposure. I used to run 115, 125 with almost no shorts. Now, I mean, look, I'm running like 80 to 90 with the flexibility to flex up if there's a crash. And I'm running with crash puts and some other things. Like, it's just changed how I'm approaching things.
Yeah, that makes a lot of sense. I'm just a complete amateur at this, but one thing that I've done that's actually worked kind of well, I'd love to get your opinion on it, is instead of trying to take like outright positions, I'm trying to just think about spreads. So as an example, when the spread between the 2-year and the 10-year was maybe 40, 45 basis points. I look at a chart of the 2s and 10s spread going back to other times when the curve inverts. And when it uninverts, usually that's when the stuff hits the fan. But usually you get a big bull steepener because the Fed drops really quick in response. And then after they get down to zero or whatever, then you get a bear steepener. So you go from inversion to like 150 basis point spread to like a 250 or 300. And I thought to myself, that makes a lot of sense. And what's great is if we do go into a massive recession, you probably get a bull steepener, in which case you win. And then if you're completely and totally wrong, and the economy just completely takes off, then inflation expectations, growth in expectations increase, and you probably get a bear steepener. So the only time you lose is just with like a flattener, and the probability is probably a little bit lower than those other two outcomes. So I've been trying to play it in that way more so than just I'm going to go straight long the 10-year or straight short the 10-year.
Yeah, I mean, look, I've never really played with those spreads. I'm truly embarrassed to admit that I'm long 10s and 30s, both of them. I hate bonds with such passion. I know they're totally worthless. I just think they might get one last Pavlovian, oh, we're having a recession, like let's go buy some bonds. And look, I go on Twitter. There's not a single man who's long bonds right now. The 60-40 portfolio is dead. I mean, the 40 really is Bitcoin, or it's gold. If you're a boomer, it's no one has bonds anymore. Everyone says nothing stops this train, except for the train kind of fell in the ditch. Like the economy sucks. I don't know. I feel like an idiot owning bonds. It makes me nauseous, but I own a whole lot of bonds, and I know where to stop out if it doesn't work. And so it's kind of crazy.
Let me give you some, maybe make you feel a little bit better about that bond position. I've tried to research this as much as I could. And I've actually have an advantage because I do whiteboard videos on this stuff. I've done like, I don't even know how many now, 1,000, 2,000 whiteboard videos. So in order to do a whiteboard video, you have to do a little bit of research. And I think the reason why bonds, the long end of the curve, usually trades with growth and inflation expectations, and has nothing to do with supply. Because the reason why the bond, owning the bonds, makes you sick to your stomach is because you see the supply increasing, which is absolutely going to happen. The deficits are going to blow out. The debt, in my view, in 3 to 5 years is going to be at 50 trillion. Absolutely. But the reason that hasn't mattered in the past is because of the mechanics of the bank's balance sheets, because the banks, at the end of the day, especially in the Eurodollar system, are the marginal buyer. So if you do have the 10-year treasury, let's say trading at 8% to take it to an extreme, and with nominal growth in the United States, or nominal growth nominal GDP expectations, let's just say 4.5, that's a huge opportunity for them because their funding costs are 2%, and they can get 8% on a treasury, and they can hedge out the maturity risk. So that's kind of the equalizer. So if you get this, that's why if you look at a chart of nominal GDP and the 10-year treasury yield, the 10-year treasury yield going all the way back to like the 1950s is like a smoothed out trend of the nominal GDP in the United States. And I think that's why, because the banks are the marginal buyer if it gets out of whack as far as the yields on the upside. And then they're the marginal seller if the yields get too low versus growth and inflation expectations, because they can take that balance sheet and they can lend into the real economy, and the risk reward makes more sense.
It makes perfect sense to me. I mean, I haven't really thought of it that way. I've always just kind of tracked it more against inflation expectations. But I mean, nominal is, a good chunk of that is actually just inflation as opposed to real growth. Look, I don't pretend to be a bond guy, but I'm a guy who sees a giant recession coming, and I don't know what else to do.
Yeah. I mean, I just wanted to try to make you feel a little bit better about that.
No, look, I think you're making a good point. I hadn't actually thought about it. It's something like you telling me this makes me want to grab my Bloomberg and start like playing with it for 4 hours until I hadn't thought of it that way.
Yeah, maybe I've created a monster. Well, people that watch my whiteboard videos, they know my view on this, so I don't want to belabor it any further. But let's go into some of the gold stuff. I mean, gold 4,000. I think this is another thing that we can learn from a professional hedge fund manager, because what I get in the comments of my videos and from a lot of the retail investors that I hear from via social media is most of them are long gold, and they have been for quite some time. So they've done extremely well, but they're all like freaking out and kind of panicking, saying, oh my gosh, is it time to sell? Is it time to sell? Is it time to sell? Especially the people that own the miners. So how are you looking at gold, and how are you looking at the miners right now?
So I don't have any miners. I wish I did. Gold, look, I think it's going much, much higher. I think when you're long gold, and we don't own any, I mean, I personally own gold, but when you're long gold, I think you need to look at it and say, do I plan to be a long-term owner of this? And my physical, I'm never selling. And then do I plan to trade it? Look, it's really overbought. Overbought things get more overbought. If you feel anxious, sell a few. Historically, when gold gets past 2 times all-in sustaining costs, it's really overvalued. It's expensive. Gold is expensive. Gold-silver ratio, gold, I guess the silver's caught up a little lately, but gold-oil ratio, like gold housing ratio, yeah, like it's getting expensive. It might make sense to flip into some other product, or you might just think the world's really changing and they're resetting the monetary system, which is kind of what I think. And it's a good, nice own. We're expressing our view in gold in 2 ways. One, we own a company called Sprott. They're an asset manager. They manage about 2/3 precious metals, 1/3 uranium. I'm bullish precious metals. I'm bullish uranium. When the price of those underlying commodities go up, their AUM goes up. And then since Americans love FOMO, they get inflows. And so you get to have an asset light way to play the price of gold going up. And more importantly to me, I think, is investor reallocation to gold. Investor weightings are beyond absurd in terms of their exposure. I mean, most investors own 0. And most investors should own a couple percent, or at least that's where it's historically been for decades. And so as that capital comes back into gold, I think Sprott will see their AUM go up and they'll earn some fees. And management's a little greedy with their revenue share, but they'll share a little with me. And look, it's done okay for us, especially this year. I also own a company called Major Drilling. They're the largest drilling company in Hard Rock. If I know anything about gold cycles, eventually people give scummy juniors money, and those guys go turn the woods into Swiss cheese looking for gold. And my Major Drilling should, get their pro rata share, or probably a little better, of the money that's spent looking for gold.
Right.
And it turns out to be a really good way to play what's happening with gold. I'm not against miners. At 4,000, they're making a lot of money. I just know that as soon as gold miners start making money, governments start looking around and saying, hey, why are these guys making money over there? Like, what's going on? Right. And, they start nationalizing, taxing stuff. And, gold CEOs don't understand what capital allocation is. And suddenly they start buying little junior companies and building new mines. And you'll never see that money. And I'm a dollars in, dollars out guy. I want my dividends and I want my buybacks. And I don't want you investing in mines that take 10 years to produce any money for me. 10 years is a lifetime in the crazy world we're in. And so, no, I don't know any of the miners, but I think Major Drilling will do quite well. And look, the stock finally woke up after, call it a 15-year slumber. But the last cycle, it was like a 20x. I'm talking about the 2002 to 8 cycle. And so I don't think it's as good as this cycle, but this cycle might be crazier. Who knows?
Do you take some off the table and allocate it to oil? Or what are your views on oil? I know I've heard in the past you say that you're very bullish. I don't know if you are now.
I was bullish.
I know today it's under 60, isn't it?
Well, the problem with oil is that I believe we're going to have the mother of all depressions.
Yeah, that's
in terms of economic activity. It won't look like a depression because they'll do tons of stimmies and they'll do tons of inflation and they'll lie about the inflation. So they'll somehow backwards engineer real GDP. But, when you ask the average guy you meet in a bar how their standard of living is, they tell you it sucks. And that's usually not good for oil consumption. And what we've seen is that there's a lot of oil in this world. There's been underinvestment. So if oil demand goes back to 2 million barrels a day of growth, it's not enough. If it's 1 million, I don't know. It's not that exciting.
Okay. Well, buddy, I know that you got a volatile day, to say the least, following Trump's tweets.
It's
So
been a good day.
I'll
We don't have that many of these. Be excited.
I'll let you get back to it. I sure appreciate you coming on, man. It's a great conversation, very entertaining, very insightful. How can people find out more about what you do?
So you can go to pracap.com, PRACAP, and sign up for my blog. I don't write that often, a couple times a quarter, but when I have something to say, I write. Or go follow me on Twitter. That's @HCuppy. And I hope I don't offend you too badly.
No, and by the way, Cuppy is extremely well known for his memes. His meme proficiency is right up there with the greats of all time. So you definitely, at the very least, you got to follow him on Twitter.
Yeah, I'm using the entire data center just to make my memes.
All right, man. Thanks for coming on. Have a good one.
Thanks for having me. I really appreciate it.